1-year Treasury bonds are currently yielding around 5.5%, and this is a major trap for retirees because I see them loading up too much money into these 1-year Treasury bonds. I see them putting 10, 20, 30% of their entire investment portfolio into 1-year Treasury bonds, and this can really screw up their retirement income because it's significantly misaligning their spending with their investment assets. And good retirement investment planning is about aligning the timeline of your investments with when you need to spend those investments. Let me show you what I mean. You can see here on this graph, most retirees want spending something like this, right? Pretty level, maybe it increases a little bit over time to account for inflation. That's what retirees want. So when you have this sorts of spending, a great way to kind of segment your portfolio, make sure you have the spending when you need it, is to say, okay, it's just to match up certain assets with spending. So for example, at 15 years, any spending 15 years plus, we'll do stocks because stocks are long-term investments. They tend to do well over the long run, but in the short run, they can be really volatile. Who knows where the stock market's going to be in a year? Could be up 30%, could be down 30%. That's a big variance. And now, again, I say 15 years here, maybe for a conservative retiree, you can go down to as little as 7 years, I'd say, maybe even 5 if you want to be really aggressive. There's kind of some preferences in there, but let's say this retiree is conservative. And so from 2 years of spending to 15 years of spending, they have it in bonds. So they have bonds that are going to be maturing. And when those bonds mature, they're going to be there to give them that spending in that year they need it. And then they also have the bond interest income to also spend over time. And then less than 2 years, that's where you'd have your cash needs. And so 1-year Treasury bonds lined up are in the cash category. So if you put 30% of your investment portfolio in 1-year Treasury bonds, you're basically putting 30% of your investment portfolio in cash. And you're saying, okay, I'm going to be really safe and secure with this money, but you're misaligning. Cash is meant to be spent in the short term, right? It's not a long-term investment. It's a short-term investment. But I see people loading up. That's essentially them betting on interest rates rising. And again, maybe interest rates will, maybe they won't. Interest rates are notoriously difficult to predict. But a key piece of information we have today is that the market is predicting that Treasury interest rates are going to decrease over time. And we know this because we can look at the Treasury bond curve and see, hey, 30-year Treasuries, the interest rate is lower than 1-year Treasuries, which is the bond market's way of saying, yeah, we don't think this high interest rate environment is going to last. Bond market can always be wrong, but again, that's a strong signal telling you that, these high interest rates may not last forever. We don't know how long they're going to last. And again, another thing for retirees is, yes, the 10-year Treasury is currently giving you around 4.5%. So yeah, 4.5% isn't as good as 5.5%, but if you can lock in 4.5% for around 10 years, that can be really helpful. And if interest rates decrease, that means that bond prices increase, and a 10-year Treasury bond price is going to increase much more if interest rates decrease than the price of a 1-year Treasury bond. So investors, don't get too caught up in that sweet 1-year interest rate of 5.5%. You want to make sure you're aligning your investments with your spending needs. And that means taking some Treasury bonds that are longer term. Even though you have to take some risk with them, you're being rewarded with a longer term interest rate, and you're locking that interest rate in for a longer period of time. So go out there, maximize that retirement spending. Happy retiring. And don't forget to hit that subscribe button, folks.